All right, welcome everyone to the deep dive. We're tackling a topic today that I'm sure a lot of you've seen in the news lately, household net worth. It's been making some pretty big moves upwards, at least in the US, especially since 2019. We're going to dig into a new report from TIAA that really tries to unpack what all this means, for the everyday American consumer. Because let's face it, despite, well, everything going on in the economy, people are still out there spending.
Yeah.
And understanding this jump in net worth might hold the key to why.
Exactly. And that's exactly what we're going to do today. We'll break it all down. What exactly goes into calculating household net worth? How is all this newfound wealth actually spread across different income levels? And believe me, that's a whole conversation in itself. And then we'll zoom out and put it all in historical perspective. Just to see how unusual, how truly remarkable this surge has been. Our goal today is pretty straightforward. Give you a clear, insightful look at what's being called the household wealth effect. And we're going to use the info from this TIAA report to do it.
Okay, cool. Sounds good. I think before we get too far, though, we've got to sort of define our terms here. Like, what even is household net worth? It sounds kind of, jargony. What are we talking about here in plain English?
Okay, yeah, good point. Think of it this way, like your own personal balance sheet. Okay, on one side, you list everything you own, your house, your car, the money you've got sitting in savings accounts, any investments you have like stocks or bonds, even things like your retirement funds. That all goes on this side. And then on the other side of this balance sheet, you list everything you owe. So your mortgage, any car loans, credit card balances, student loans, you name it, whatever debts you've got. Household net worth is basically what you're left with when you subtract all that debt from your assets. So it's the big picture, the overall snapshot of, how you're doing financially.
Okay, that makes a lot more sense. And the TIAA report, they're saying there's been this, tremendous rise in net worth since 2019. Can you give us, a sense of the scale here? How big are we talking?
Oh, yeah, it's huge. The report actually cites data from the Federal Reserve, and it's showing that right in the middle of 2024, U.S. households, on average, they were about 12% wealthier than they were just 2 years before. But, and here's a real eye-opener, 40%, a full 40% wealthier than at the end of 2019. I mean, that's a really big jump, especially in such a short amount of time.
40%, wow, that's a number that makes you do a double take.
Yeah.
What exactly is driving that kind of increase? Can't just be one thing, right?
You're right, it's not. It's like a bunch of factors all working together, creating this perfect storm, So the report points to really strong performance in a lot of the assets people own. So you've got things like stocks, they've generally been doing well. And then in a lot of places, you've got house prices that have really climbed up. On top of that, you've got what are called liquid assets. Basically, think of it as the money you have ready to spend, sitting in your checking account, or maybe a money market fund. A big chunk of that increase actually came from, all those stimulus measures, all that financial help that the government put into place during the pandemic. That definitely helped keep people spending.
Okay, so more cash on hand. And on top of that, the investments in houses people already own, they went up in value too. But we all know that good news in the economy, it doesn't always reach everyone equally.
Yeah.
What does the report say about how this wealth, this increase in net worth, has been distributed across different income levels? Because I feel like that's something people listening really need to pay attention to.
It's absolutely critical. While the total net worth has, it's gone up by a lot, how it's been shared out, that's not even close to equal. Figure 1 in the report really lays this bare. Shows that the top 20% of households in the U.S., they just hold a massive share of all the wealth. And these are the folks who are way more likely to own things like stocks, real estate, the stuff that, like we were just saying, has been the engine behind this net worth boom.
So if you were lucky enough to already have more of those assets, you probably saw more benefit from these price increases.
It's pretty straightforward. And what's also interesting, the report points out that these households, the higher income ones, they're usually less affected by all these rising interest rates. Why? A lot of them locked in these super low fixed rate mortgages ages ago, so the recent hikes in rates, they haven't really changed their monthly housing costs that much.
Which I'm guessing is a very different story for folks who aren't as likely to own those kinds of assets.
Exactly. Think about the households who aren't as invested in things like stocks and real estate. Folks who rely more on those loans with changing interest rates, like credit cards or auto loans. Those rising rates, they've hit these folks way harder. And the report puts some numbers to this, some pretty telling numbers, actually. So remember those liquid assets we were talking about, the readily available cash? Well, since the end of 2019, after you factor in inflation, those assets only grew by about 5% for the bottom 60% of income earners. Now, compare that to the top 20%, their growth was a whopping 13%. So for a big chunk of the population, that extra cash, that cushion, it just hasn't kept up with how much everything costs now.
Wow, that's a real gap, a real difference. And figure 2 in the report, it really drives this point home. It shows that those top 2 income groups, they control something like 85% of the total household net worth in the entire country. But here's the thing, they only account for about 62% of all spending. That's a big difference between who's holding all the wealth and who's actually out there buying stuff, driving the economy.
Totally. It really underscores how these gains, this wealth surge, it hasn't been evenly spread at all. And this actually brings us to this big concept the report dives into, the wealth effect.
The wealth effect, yeah, you hear that term thrown around a lot. Can you, break it down for us, like in everyday terms? What does it actually mean?
Yeah, sure. The wealth effect, it's basically this idea that when they feel richer because, their assets, things like their house or their investments, they've gone up in value, well, they tend to get more optimistic about their whole financial picture. That boost in confidence, it can lead them to spend more money. It's almost like feeling richer on paper actually makes them more willing to open up their wallets. And you can see how this could create this whole cycle, right? Higher asset prices fuel this good feeling, leads to more spending, that pumps up company profits, and then that could push asset prices even higher, and so on.
So, like, if your stocks are doing well or your house value shoots up, you're more likely to, I don't know, buy that new TV or take that vacation, even if your actual paycheck hasn't changed.
Yeah, that's the heart of it. But the report also throws in a little word of caution. They say, don't just look at the current net worth level on its own and get all excited. Figure 3, it shows us that right now, like, total household net worth, when you compare it to total personal income, it's high, really high. It's more than 6 times what we collectively earn.
On the surface, that sounds like a good thing, right? More wealth compared to what we're actually making.
Yeah, you might think so. But the report actually calls this a coincident indicator. Like, imagine it this way. It tells us what's already happened, but it doesn't really tell us what's coming next. And here's what's a little, maybe unsettling. Figure 4, it points out something really interesting. It says that the 12% net worth growth that we've seen over the past 2 years, well, that's actually pretty close to the average growth we saw in the 2 years leading up to all 4 of the recessions we had since 1988.
Oh, wow. Yeah, that does give you a pause for thought. So is the report saying, like, that a recession is definitely coming?
No, not directly predicting that. They're very careful to say that, like, hey, just because net worth is up, it doesn't mean a recession is a sure thing. What they're saying is that this increase in wealth on its own, well, it's not some kind of magical shield against a future economic downturn. And remember, all that inflation we've had lately, that's actually eaten away a big chunk, over half, actually, of the net worth growth we've seen just on paper. So the real growth, once you account for that inflation, it's actually not as impressive as it might seem at first glance, especially when you compare it to some past periods.
Okay, so it's like the wealth effect. Yeah, it can be a powerful thing, but it's not a guarantee that the good times are going to keep rolling. And we've got to look beyond just the big headline numbers. Now, the report does lay out some potential risks, things that could actually reverse all this growth in net worth. What are they most worried about?
Okay, so they highlight 3 main areas of risk. The first is all the geopolitical uncertainty. The tensions in the Middle East, especially with this whole conflict going on with Israel and Hamas and like the possibility of it drawing in other countries in the region, that's a big worry. They specifically mention the risk of this conflict spreading to Iran. And if you think about it, Iran, they're a huge oil producer. So if they get involved, that could really mess with oil prices, gas prices, not to mention like the overall mood of consumers and businesses. And we all know when gas prices spike, it hits everyone's wallet.
Absolutely. We all see it when we're filling up our tanks. But I think the report does say that, like, the U.S. economy, it's not quite as vulnerable to those swings in oil prices as it used to be, right?
Right. Yeah, you're right. Like, they actually show this in Figure 5. The amount of energy that the U.S. economy needs for every dollar of GDP it produces, it's basically been cut in half since back in the 70s. So while a sudden jump in oil prices, yeah, we'd still feel it, the overall impact on the economy might not be as bad as it would have been in the past. But they do point out another risk, a geopolitical one, that could be way more disruptive. A potential Chinese invasion of Taiwan. And when you consider how crucial Taiwan is to making semiconductors, the brains of pretty much all our technology, that's a whole other level of worry.
Yeah, that would send shockwaves throughout the whole global economy, way beyond just what happens with oil and gas. Yeah. Okay, so that's one big risk. What's the second one they're keeping an eye on?
The big one, the U.S. elections. The report is basically saying that whoever wins, there's a real chance of some major shakeups in economic policy. For example, they mentioned the possibility of former President Trump, if he were to win, bringing back those tariffs on goods coming in from China and other countries. And those tariffs, they could make prices go up for consumers, create all this volatility in the markets, and potentially eat into company profits.
And tariffs, those are things that can be put in place pretty quickly, right? So that could create some, immediate uncertainty.
That's a big concern. And then on top of that, the report is also saying that both the Republicans and the Democrats, their current economic plans, well, they could lead to a pretty big jump in the national debt, which could eventually push interest rates up and cause some instability in the markets. On the Democratic side, you've got Vice President Harris. She's put forward this proposal for higher taxes on, higher earners, corporations, and capital gains. That could definitely shift investor sentiment, take a bite out of people's disposable income, and impact corporate earnings. Plus, we can't forget that the tax cuts from the TCJA, the Tax Cuts and Jobs Act back in 2017, those are set to expire in 2025. So even without Harris's proposal, some kind of tax hike for higher earners is probably in the cards no matter who wins the election. So the election, it's like this giant question mark hanging over everything, could really change the whole economic landscape. And that uncertainty just by itself can spook consumers and investors alike.
So big election, big potential changes. Got it. What's the third major risk the report flags?
The third one is how the labor market plays out. Even if, we dodge those geopolitical bullets and there are no crazy policy swings after the election, the labor market, it's been really strong, but it could start to weaken. And they're suggesting that all these high interest rates that are supposed to, cool down inflation, well, they could start to squeeze businesses, especially smaller ones. And that could lead to hiring freezes and eventually, even layoffs as companies get a little nervous about what's coming next.
Yeah, it's true. The job market has been pretty robust for a while. Is there anything that makes them think that could change, significantly soon?
Well, even though the labor market has been really resilient, the report reminds us that those higher interest rates, they can take a while to fully kick in. But okay, the good news is there are some things that might actually help soften the blow if the economy does slow down.
Okay, that's good to hear. What are those things? What could help prevent things from getting really bad?
Okay, so one big thing is that the Federal Reserve, they're willing and they're actually able to adjust their monetary policy if they see the labor market starting to really tank. The report even mentions that they were already talking about a potential interest rate cut as early as September. So that shows you they're ready to step in if things start to look dicey. And because the current benchmark interest rate, the Fed funds rate, it's still pretty high, they have room to bring it down, to give the economy a little boost. And that benchmark rate, think of it as like the control knob for all sorts of borrowing costs you're probably familiar with, credit card rates, mortgage rates, that sort of thing.
Yeah, that makes sense. They do have some levers to pull. What else could help us avoid a major downturn?
So the report points out that, yeah, we've got a lot of people working, employment is strong, but it's only a little bit above its long-term trend, especially compared to those peak economic periods we saw back in 2000 and 2007. What that suggests is that businesses might not be as overstaffed as they were back then, and that could mean fewer layoffs if things do take a turn. Another positive sign is that household debt, when you compare it to the size of the whole U.S. economy, what we call GDP, it's come down a lot since that financial crisis in 2008, a lot lower. And the portion of our take-home pay, our disposable income that we're spending to pay off debts, also way lower than it used to be. So basically, on average, consumers are in a much better position to handle economic rough patches without having to make huge cuts to their spending. So your household probably has a little more breathing room in the budget now than, say, back before 2008.
So we're carrying less debt, and we have a little more wiggle room in our finances overall. That's good.
Exactly. And then there's the banks. The report stresses how they're in way better shape financially now than they were in 2008. They've gone through all these tough stress tests. They have more capital in reserve. And that should help make sure that people and businesses can still get loans, even if the economy slows down. And last but not least, the housing market. It's in way better shape now than it was back in 2007. There isn't as much overbuilding going on. Vacancy rates are lower. And most importantly, way fewer mortgages have those adjustable interest rates, which were a huge problem during the last crisis.
So it sounds like both regular households and the whole financial system, they're in a much healthier place than they were leading up to those past recessions.
That's a key takeaway for sure. But they do acknowledge that even if we manage to sidestep a major crash, we could still see some bumps in the road, some volatility in the markets, especially since stock prices and what are called credit spreads, that's the extra yield investors want for holding riskier corporate bonds, those are both higher than their historical averages right now. So if there's any bad economic news, those assets could take a hit, and that could definitely dampen that wealth effect we were talking about. Imagine a credit spread like the extra fee a borrower with a little bit of a shaky financial history has to pay compared to a borrower who's super reliable.
Got it. So even without a major economic meltdown, our investments might still be in for a bit of a roller coaster ride. Okay, so we've talked about the immediate risks, but the report also looks at the long term. What are they saying about the big picture?
Overall, they're pretty optimistic. They're like pointing to all the strengths of the US economy, the fact that we keep getting better at producing goods and services, what economists call productivity, and of course, the potential for all these new technologies like artificial intelligence to completely change the game.
It's so easy to get caught up in all the worries, so it's good to remember those bigger, longer-term trends, the things that ultimately drive growth. And what about investment recommendations? I think the report touches on that a bit, doesn't it?
Yeah, they basically say don't panic and sell everything if the market gets choppy. They're big proponents of having a solid, diversified investment strategy, a long-term plan for how you've got your assets allocated, and being ready to make some smaller tactical shifts as things change in the market.
Okay, so let's wrap this all up for everyone listening. We really dug into this concept of household net worth, how much it's grown since 2019, all the different forces that have been at play. We've seen how this wealth is, well, not exactly evenly distributed, explored the wealth effect, and looked at those storm clouds on the horizon, those potential risks.
Hmm.
Everything from global events to our upcoming elections and even the state of the job market. But we've also highlighted some of the reasons why we might not be headed for a full-blown economic disaster.
And it's super important to remember that while all this extra net worth, yeah, it's given a lot of folks a cushion and helped prop up spending, the health of the job market, that's still the bedrock, the most important thing for a strong and stable economy. Sure, it's nice when your assets go up in value, but it's not a replacement for a steady paycheck.
So here's something to think about as we sign off. We talked about how concentrated wealth has become, and we know the elections could bring some pretty big policy changes. So think about it. What could this all mean for how people spend their money in the long run? For the whole economy, not just, that immediate feeling richer effect. How could all these trends and potential shifts affect your own finances in the years to come? It's definitely worth pondering. And thanks for joining us for the deep dive.